Welcome to today's deep dive. We are really thrilled you're joining us. If you have ever looked at the sheer volume of investment vehicles out there and felt like you were just drowning in an alphabet soup of acronyms and asset classes, you are certainly not alone.
Oh, absolutely not alone.
Yeah, whether you are rebalancing a portfolio, doing due diligence, or you're just endlessly curious about the actual mechanics of wealth creation, the whole financial ecosystem can seem like a chaotic, sprawling mess.
It really can.
But today, we are going to organize that chaos. We are taking a single piece of incredibly dense visual information, basically a cheat sheet for the financial universe, and unpacking it so you can use it to map out your own capital allocation strategy.
And we really do have a fascinating source to dissect today. It is a visual guide created by Brian Feroldi. It's straightforwardly titled 16 Investing Options.
Right.
And what makes this document so compelling isn't just that it, lists out different places to park your money. It is the underlying architecture of the graphic. It takes the entire spectrum of investable assets and plots them on a very specific, unforgiving grid. It essentially strips away all the marketing jargon and forces you to look at the raw mechanics of capital markets.
And before we start analyzing the individual options, we have to establish the physical laws of this universe.
Good point.
Every single one of these 16 options is pinned to a two-dimensional graph. The x-axis, running horizontally along the bottom, represents risk.
Risk.
It explicitly moves from lower risk on the left to higher risk on the right. Then you have the y-axis, running vertically. That represents return. It starts at a lower expected return at the bottom and climbs to higher expected return at the top.
It is essentially the golden rule of finance, translated into a visual medium. I mean, you cannot look at this chart without immediately understanding that there is no free lunch in capital markets.
Definitely not.
The fundamental premise we are exploring today is the unbreakable correlation between the risk you are willing to stomach and the premium you demand for taking that risk.
Exactly. So the mission of our deep dive today is to act as your guides, navigating step by step through this financial spectrum. We're going to decode exactly why certain asset classes sit where they do, the macroeconomic realities that anchor them there, and how shifting your portfolio in one direction automatically alters your exposure in another.
I love that.
Okay, let's unpack this. We're going to start at the absolute bottom left corner of the chart, ground zero.
Ground zero is our baseline. Tucked all the way down in that bottom left corner, registering the absolute lowest on both the risk and expected return scales, we find the money market.
Yeah, and what jumps out immediately when looking at the graphic is that money market is totally isolated.
It is.
Later on, we're going to see these large, distinct groupings that cluster different asset classes together, but money market sits entirely outside of those major boundaries. It's just hanging out on its own little island of safety.
And its placement outside the main ecosystem is a deliberate statement about its function. When you are utilizing a money market fund, you are essentially holding cash or ultra-short-term cash equivalents. You aren't really investing in the traditional sense of seeking growth.
Right, you're prioritizing capital preservation.
Exactly. Because the risk of nominal loss is practically non-existent on this chart, the expected return is firmly anchored to the floor. The fundamental trade-off happening in that bottom left corner is that you are prioritizing the return of your capital over the return on your capital.
Safe from nominal loss, sure, but we both know there's an invisible tax happening there.
Oh, absolutely.
If you park all your wealth in a money market for a decade, inflation is going to quietly erode your purchasing power. So while it's the safest asset on the chart, holding too much of it introduces a totally different kind of macro risk.
The risk of outliving your money.
Precisely.
That is a critical distinction to make. The x-axis here represents the risk of capital loss and volatility. It does not necessarily measure the insidious risk of inflation. And that exact reality, the need to outpace inflation, is what forces investors to step off that safe little island and enter the actual progression of the chart.
Right, which leads us to the first major structural grouping. As soon as we shift slightly to the right and slightly up from the money market, we cross a threshold. It's this massive section labeled fixed income.
This is where the ascent begins. The very first entry inside this fixed income universe is U.S. Treasuries.
So you've taken a minor step to the right.
Yes, a minor step to the right on the risk axis and a corresponding tick upward on the expected return axis. By purchasing sovereign debt, Specifically, lending your capital to the United States government, you are taking on a fraction more risk than simply holding cash in a sweep account. And in exchange, you capture a slightly higher yield.
But let's push back on that safety for a second. We saw what happened to the bond market in 2022.
Oh, it was brutal.
Treasuries are generally safe from default risk because the U.S. government can always print more money to pay its debts. But they aren't immune to interest rate risk. If you are holding a 30-year Treasury and the Federal Reserve suddenly hikes rates, the secondary market value of your bond gets absolutely crushed.
Which perfectly illustrates why U.S. Treasuries are further to the right than cash. Duration risk is real. The longer you lock up your money, the more you are exposed to shifting macroeconomic winds. But moving right along, just a millimeter further up the expected return axis, we encounter TPS, or Treasury Inflation Protected Securities.
Which feels incredibly relevant given the economic climate of the past few years.
It really is. TPS are still sovereign debt backed by the U.S. Treasury, but their principal value is directly pegged to the Consumer Price Index.
So if inflation spikes,
the principal adjusts upward. The visual placement here is wonderfully precise. To secure that specific structural protection against inflation, you are altering your return profile slightly compared to nominal treasuries, shifting your position just a fraction higher.
So we have exhausted the relative safety of government paper. If an investor wants to scale up their yield, where do they have to deploy their capital next? We move into the corporate and municipal debt markets. The progression here goes from municipal to corporate and finally up to high-yield options.
What's fascinating here is how accurately this section models the realities of credit spreads and yield chasing. Consider the step from U.S. Treasuries to municipal bonds. You're shifting from lending to the federal sovereign to lending to a local state or city government.
Right, local governments.
The default risk increases marginally. Cities do occasionally declare bankruptcy after all, so you demand a slightly higher yield. Then the chart forces you further right. You transition to corporate bonds.
Because an established corporation, no matter how massive it is inherently more fragile than a municipality with taxing authority.
Precisely the point. When you buy a corporate bond, you are taking on corporate default risk. The company could be mismanaged, face a disruptive competitor, or suffer a massive supply chain collapse. Because the likelihood of default is higher, the liquidity premium you demand must be higher. And if you still aren't satisfied with that yield, the chart pushes you right into the high-yield tier.
Also colloquially known as junk bonds.
Junk bonds, yes.
These are the companies with sub-investment grade credit ratings. High yield is essentially the friend who promises to pay you back double on Friday if you just spot in $50 today.
Yeah.
You might get a fantastic return, or you might end up screening their calls and writing off the loss entirely.
That is a highly accurate, if slightly painful, analogy. You are lending capital to highly leveraged or distressed companies. The default risk is substantial, which is why they have to offer such lucrative coupon rates to attract capital in the first place. The upward rightward trajectory from municipal to corporate to high yield is essentially a masterclass in credit risk pricing.
And then we hit the absolute ceiling of the fixed income world. Sitting at the peak of this specific debt mountain is an option simply labeled global.
Global bonds max out the risk and return potential within the traditional fixed income framework. Now, you aren't just taking on corporate or municipal default risks.
You're layering on geopolitical instability.
Exactly. Geopolitical instability, currency fluctuation risk, and totally unpredictable foreign regulatory environments. If the local currency of the sovereign debt you purchase plummets against the dollar, your returns can be completely wiped out, even if the bond itself never defaults. It is the furthest edge of a fixed income map.
But the chart doesn't stop there. And here's where it gets really interesting, because the visual layout undergoes a radical structural shift. Right after the fixed income grouping, there's an anomaly that serves as the linchpin of the entire document.
The bridge.
Right, sitting dead center, completely isolated from major groupings but connected by dotted lines, is real estate.
It is the focal point of the whole exercise. If you trace the lines Feroldi has mapped out, they tell a profound story about asset allocation. The line from the top of the fixed income sector connects directly to the lower boundary of real estate. Meanwhile, another line connects the upper boundary of real estate directly into the base of the next major category, which is equity.
It's positioned as the literal bridge between two distinct financial philosophies. But I want to scrutinize that for a moment. Putting real estate dead center makes total sense for its return profile. You get steady rent combined with property appreciation.
Right.
But what about the liquidity premium? You can liquidate a $1 million Treasury position in milliseconds. Selling a commercial property or even a single-family home can take months, and the transaction costs are massive. Doesn't that inherent illiquidity add a hidden layer of risk that a simple two-dimensional graph might be smoothing over?
That is a fantastic critique, and it actually reinforces why real estate sits further to the right on the risk axis than
Yeah.
any domestic fixed income product. That illiquidity is exactly what you are getting compensated for. I see.
Real estate acts as a hybrid asset class. On one hand, you collect rent, which mimics the reliable contractual cash flows of a bond. It provides a defensive baseline. On the other hand, the underlying property can appreciate in value, which is the defining characteristic of an equity.
The capital gain.
Exactly. You are taking on illiquidity risk and physical asset risk, like a roof collapsing or a neighborhood suddenly declining, to capture both a yield and a capital gain. It bridges the gap between being a lender and being an owner.
So we cross that illiquid bridge and officially enter the equity realm. We are leaving the world of debt covenants and entering the world of business ownership, shareholder equity, and public markets.
And following the physical laws of this graph, stepping into the equity arena demands a massive jump to the right on the risk axis
A huge leap.
and a significant leap upward in expected return. You are now at the bottom of the capital structure. If a company goes bankrupt, the bondholders get paid out first. Equity holders are the absolute last in line, often left with nothing.
Let's break down the foundation of this equity section, because the nuances here explain so much about different investing philosophies. The first three steps inside this new frontier are dividend stocks, followed by large cap value, and then large cap growth.
The contrast here is incredibly important for any investor to understand. Look at dividend stocks. They sit at the very base of the equity staircase, hovering closest to the real estate bridge and the fixed income sector. Their geographic placement on the chart implies they are the most conservative way to own equities.
Which makes sense, because a company paying a healthy dividend is usually a mature, cash-flowing behemoth. They aren't out there trying to invent a new industry. They're just distributing their excess profits directly into your brokerage account every quarter.
Exactly. That tangible cash payment provides a buffer during market downturns, effectively lowering the overall volatility of the investment. Because the risk is somewhat mitigated by that reliable cash flow, their expected return sits a bit lower on the y-axis. But right above that, you have large cap value.
Value is an interesting one because it's often misunderstood. People hear value and they think it just means cheap.
Right.
But in this context, large cap value companies are often the mature stalwarts that the broader market is currently ignoring or actively penalizing. You're taking on the risk that the market has mispriced them, hoping for a reversion to the mean. You are betting that a legacy automaker, for instance, isn't actually a dinosaur, and the market will eventually recognize its strong balance sheet.
That's spot on. You are taking on the risk of catching a falling knife or holding dead money, which pushes it further right than a reliable dividend payer. And then we contrast both of those with large cap growth, which sits significantly higher and further to the right.
Large cap growth companies are the ones making headlines. They're often tech giants or aggressive disruptors that reinvest nearly every single dollar of free cash flow back into research, development, and expansion. They aren't handing you a dividend. They are trying to conquer the globe.
And funding that ambition requires the investor to shoulder significantly more risk. You are trusting that management's massive reinvestment strategy will eventually translate into exponential earnings growth and a skyrocketing share price.
A huge leap of faith.
Yes. Without the cushion of a dividend, these stocks are highly sensitive to shifting interest rates and macroeconomic sentiment. You are climbing the risk curve, accepting intense volatility for the expectation of a heavily delayed but potentially massive capital appreciation.
You essentially trade the certainty of cash today for the possibility of dominance tomorrow. But we are still only in the large cap space. As we continue ascending the equity steps, we start moving down the capitalization scale. We shift from large cap growth up to mid cap, and then another step up to small cap.
If we connect this to the bigger picture, the chart is brilliantly illustrating the economic reality of agility versus fragility. When you move from a massive, globally entrenched mega-cap company down to a small-cap stock, you are inherently taking on more existential risk.
Because a massive blue-chip company has a fortress balance sheet. They have the credit lines and the wildly diverse revenue streams to survive a severe recession. A small-cap company might only have 2 flagship products and operate in a highly specialized cyclical niche.
They are drastically more fragile. A supply chain hiccup or a single bad earnings quarter could severely threaten a small cap company's solvency, whereas a mega cap wouldn't even blink. But the inverse is also true regarding growth potential. A company worth $1 trillion is going to find it nearly impossible to double its market share anytime soon.
The law of large numbers.
The law of large numbers becomes an anchor. A small cap company, however, has a massive runway. They have the potential to 10x or 20x in value if they hit the right market fit. Therefore, the market demands a significantly higher expected return to justify the very real risk of that smaller company going to zero.
It perfectly captures the risk premium of size. Smaller businesses equal higher failure rates, which demands higher potential returns for the investors willing to back them. Now, let's look at the highest altitudes of the chart. Above small cap, we introduce geographic and sovereign variables again. We hit international equities, followed aggressively by emerging markets.
Here, we are compounding multiple risk factors. We are combining the bottom of the capital structure risk of equity ownership with the sovereign risks of operating outside mature domestic markets. Emerging markets push us incredibly far to the right on the x-axis. You are deploying capital into developing economies, places like parts of Southeast Asia, Latin America, or Africa,
where the middle class is exploding and the GDP growth can just dwarf the developed world.
The macro growth narrative is massive, which justifies the high placement on the expected return axis. But the risks are equally massive. You are dealing with intense currency volatility, the potential for sudden political upheaval, lack of transparent corporate governance, and less mature regulatory frameworks. A sudden regime change can wipe out foreign equity holders overnight. The risk premium required to invest in those environments is enormous.
And that finally brings us to the peak. The journey culminates at the absolute top right corner of the chart, the final frontier, venture. So what does this all mean?
It means we have reached the terminal velocity of the risk-return trade-off. Venture capital represents the absolute maximum limit on the x-axis for risk and the absolute highest theoretical point on the y-axis for expected return. It is the polar opposite of the money market safe haven we started with.
In venture, you aren't investing in established cash flows or proven business models. You are often investing in a pitch deck.
Literally a pitch deck.
A founder with a vision, or a product that doesn't even have a working prototype yet. It is the ultimate exercise in asymmetric risk.
The power law dynamics of venture capital are brutal. The vast majority of these investments, often 80 to 90%, will fail completely, returning absolute zero to the investors. Another fraction might simply return the initial capital, known as walking dead companies. But the entire asset class relies on the 1 or 2% of startups that achieve astronomical 1,000x returns.
Wow.
The chart places venture at the absolute pinnacle because it forces the investor to accept the maximum probability of total capital loss for the rare chance of capturing generation-defining wealth.
It really puts the entire landscape of modern finance into perspective. To recap the sheer elegance of Brian Feroldi's visual, we have just audited 16 distinct asset classes, moving from money market to treasuries, across the illiquid real estate bridge, up through the nuanced ranks of the equity market, all the way to venture capital. But despite being 16 completely different mechanisms for deploying wealth, they all form one single unbreakable diagonal line.
That is the ultimate lesson of this deep dive. The unbroken diagonal line proves that the market is ruthlessly efficient at pricing risk. You simply cannot move up without moving right. You cannot capture a higher expected return without exposing your